Good morning. For Traders Exclusive, this is George Kachuk with RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Well, let's talk about the equity markets, and two themes I want to talk about today is rising interest rates and will we retest the February 9th lows. Okay, so the financial press and the talking heads are in a tizzy about rising rates, how this is going to ruin the stock market going forward. And I'd say we don't need to worry about this at this time. And the reason I say that, rates are still very low. And as they're rising, that's a reflection of how good the economy is going. And if we look at historically what had happened in raising rates, it's worthwhile noting what had happened. So basically, we look from about 1970 and 1996. Yes, when interest rates did rise, stock prices did go down, meaning they were inversely correlated with rising rates. Now, however, since about 1996, let's say 1998, 2000, to the present time, stock prices have been positively correlating with rising rates. So meaning, when rates went up, stock prices went up. In fact, we took the whole period between 1953 to the present day. Basically, anytime rates were rising towards that 4% rate, although we're still way off that, the 10 years at 2.9%, stock prices did very well. And it wasn't until stock prices got above 6% where rising interest rates, that's on the 10-year yield, affected stock prices in a negative way. So right now we're at hovering that area, 2.8 something, 2.9%. We're quite a ways away from either 4% or quite a ways away from either being 6%, where that would be a limit where that may affect stock prices. So that's just something to keep in the back of your mind when you read the financial press and they're telling you that rising interest rates or the yield of 10 years is going to ruin this market. I believe nothing could be further from the truth, and we can use historical perspective to give us that view. But of course, as I always say, let price and volume be your guide. Now, the next thing I want to talk about is the market plunged from the top in early February. We bottomed February 9th, and again, the mantra is that we need to retest this low because that's what happened in the last few plunges and corrections. And that's very true. However, this situation is not like 2015 or 2011 or 2008 or 2000 or 1994 and 1990. When we did get a plunge, it does tend to retest the low because this market is a much stronger trending market. And what I mean by that, this market since 2017, the fall of 2016, has been very, very strong. And typically in the years when we get a first plunge from a very strong trending market, you don't get a retest of the lows. And as a model, I'm talking about 1925, 1936, 1955, 1963. Those markets were very, very strong trending markets, and that first plunge was pretty quick. The market rebounded and continued to do well. Now, does that mean everything's fine? We don't know. There's no guarantees. However, what we're looking to see, what happens when the market starts to retest its highs from January, that may tell a different story. Except right now, I am not expecting a retest of the lows. I'm expecting the market probably to try to retest the highs, and we'll have to assess what's going on at that point. So again, this is not a buy or sell recommendation. Always consult your financial advisor. However, the most important thing is let price and volume be your guide. Whether we have theories and models of what happened in the past, price and volume doesn't lie, and that's why you should always let price and volume be your guide. So this is George Kachuk with RCM Wealth Advisors reporting to you from the CME Group trading floor in Chicago. Have a great trading week.